Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we would be discussing about Ind AS 20. This is on government grants, a tier 2 category topic with all the important questions. Now, this is a topic which may be asked in its own, or it may be clubbed with other topics like PP or an agriculture question, or most importantly a financial instruments question, whereby there are some interconnects which we will try to explore over the course of this lecture. So first of all, before we proceed, the standards coverage includes you understanding what is meant by, let us say, a government. A government can include a state, national, international, or even local authority which has administrative powers. And second is, what is grant? The difference between grant and assistance: when you look at a grant is something which is quantifiable, and it is something like a subsidy, for example, which you can quantify. Whereas assistance is something which is not possible or difficult to quantify, let us say like technical assistance or logistic support, which may be difficult to quantify. So over here, the standard says that in case there is a grant like a subsidy which can be quantified, then you can account for the same. Whereas if there is an assistance which is not possible to be quantified, you will have to give a disclosure for the same. So essentially a grant is something which can be quantified and hence accounted, whereas assistance is something which is not quantifiable and hence it needs to be disclosed. Now, in terms of scope, remember only government related grants are covered over here. So if the grants are given by, let us say, your employer or some charitable institution that is not within the scope of the standard, the accounting for the same will be as per GAAP. However, the grants given by the government will be covered by the standard. Which grants? Well, in general, all grants. However, the standard gives you scope exclusion. 4 items which will not be covered. First, if this is an equity investment by the government. If it is an equity investment, remember it is an investment for a return like dividend or capital appreciation and hence not a grant. Second is loans given at market rates. Again, grants are usually non-refundable, loans are refundable, and if they are given at market rates, there is no even interest benefit given, and as a result, loans at market rate of interest are also not grants because they are returnable. Third, tax support given by the government in form of a tax deduction, tax exemption are not covered because there is a separate accounting standard, Ind AS 12, which governs the same. While doing so, one needs to remember that it is what we are talking about is income taxes. Maybe some other taxes may be covered over here, but income taxes will not be covered, deductions or exemptions under income tax, because there is a separate standard. And lastly, in my opinion, the most important is if these are grants given for a biological asset which are covered by Ind AS 41. Ind AS 41 is a separate standard on biological assets which says that if there is a government grant for a biological asset, Ind AS 41 will apply, and as per Ind AS 41, if it's an unconditional grant, it will be taken to the P&L immediately, and if it is a grant subjected to conditions, then as per Ind AS 41, you will spread it over the year, the conditions get satisfied, and hence the provisions of Ind AS 41 will apply if the grant is given for something like, let us say, cattle or something like sheep, where these are biological assets. So when you see a question where you have a government grant, you first ask yourself that is it for a biological asset? If yes, then you directly go to Ind AS 41 and account accordingly. If no, then you come under the standard and proceed further. So point 4, in my opinion, is the more important point for a scope exclusion from an exam perspective. Next, you go to the grants covered by Ind AS 20. What is the initial recognition? When should you recognize these grants? Well, grants should be recorded when there is a reasonable assurance that the conditions attached to the grant will be complied and the grant is receivable. So you don't need to wait till the time the actual grant is received, otherwise it will become like a cash system of accounting, and you don't really need to wait till the time all conditions are complied. Even if there's a reasonable assurance or you think it is probable that the conditions will be complied, you are allowed to initially recognize a grant. Like for example, if you were to buy an electrical vehicle and the government is giving you a grant of, let us say, 1 lakh rupees. Now the government might actually release the grant, let's say, after a few months. However, the moment you buy the vehicle, you submit the application to the government and the government communicates its approval, in which case the grant becomes receivable. So you can recognize a grant even if it is not received. Secondly, the government might stipulate a condition that you need to hold the vehicle, let us say, for 3 years. However, if you believe that you will hold the vehicle for 3 years, then you can recognize the grant the moment it becomes receivable, and you need not wait till the time the condition of 3 years gets fulfilled. So this is regarding the initial recognition for a grant. Next, once you figure out that the grant has to be recognized, let us say it is a monetary grant, the government has given you 1 lakh rupees, the entry is bank account debit 1 lakhs to what are you going to credit? Well, the accounting depends on the classification of the grant, on whether the grant is classified as a grant linked to assets or a grant linked to income. Now, a grant linked to asset is defined as a grant which is for the specific purpose of acquiring, purchasing or constructing a specific asset, maybe a tangible, maybe an intangible asset. However, it is for the purpose of acquiring an asset. So what is an income linked grant? Every grant which is other than a grant linked to asset. So it is like a residual category. We are not saying that it has to be linked to income, expense. No. Any grant which is other than a grant linked to asset will be treated as a grant linked to income. So even if the government gives you a grant which is a compensation for losses that you have suffered due to a flood, or as an incentive to start a business in a backward area, this may not necessarily be directly attributable to incomes or expenses. However, since they are not linked to acquisition of a specific asset, we can say that there are grants linked to income. So grant linked to asset and grants linked to income. Now, we try to understand the accounting for grants linked to asset, like the example that we had discussed. For the electrical vehicle, a car, let's say Tata Nexon EV, this is an example of a grant linked to asset because it is linked to the acquisition of a specific car, and hence it will be covered under Ind AS 20, grant linked to assets. So when the grants are linked to assets, they can be of two types. They can be monetary grants where the government gives you a reimbursement, or non-monetary grants where the government gives you the asset itself at a concessional price. Irrespective of whether it is monetary or non-monetary, the accounting remains the same. That is, you have two choices. First, you can net the grant amount from the total cost of the asset and record the asset net. Second is, you can record the asset at the full value and instead show the grant as a separate ledger called as a deferred government grant account. So over here, let us say we take an example for a grant linked to asset where, let us say, option 1 is gross, option 2 is net. So gross method means you will recognize the asset at the gross amount. So let us say if you were to buy the asset at 300, the government gives you a grant or reimbursement of 200, and hence the entry at initial recognition would be bank account debit to asset, or sorry, when you purchase the asset, the entry will be asset account debit to bank. Let us say you are spending 300 rupees, and then bank account debit, the government gives you 200 rupees. To what? Well, you will credit a separate deferred grant account. So over here, the important adjustment would be to credit the deferred grant account. Now, what will happen? Well, assuming the life of the asset is 10 years, the asset will be depreciated. So 300 divided by 10, depreciation each year would be 30 rupees. But at the same time, the grant is for the asset. If the asset is to be written off over 10 years, ideally the grant should also be amortized over 10 years. And hence the deferred grant or deferred income or the deferred government grant, whatever amount nomenclature you use, deferred grant account debit to, let us say, profit and loss account. This will be grant amortization. 200 divided by 10, it is in the ratio of depreciation, that is 20 per annum. This will be how the grant would be amortized. So over here, this will result in, let us say, an amortization for the grant. Next, you look at the net method. Now, under the net method, you will net off the grant received from the cost of the asset. So when you purchase the asset, it is asset account debit to bank 300, and then bank account debit 202, you will credit the asset. So over here the PP will be credited, and hence the asset will be at the net amount of 100, which will be depreciated by 10 years. So 100 divided by 10, that is 10 rupees per annum, will be depreciation. There is no separate deferred grant account, and hence there is no separate question of an amortization. Now, a few special cases that can be impacted over here can be, again, this is for monetary grant. A similar treatment will be for a non-monetary grant where you directly pay 100 only. So over here, in the first option would be asset account debit 300 to bank 100 to deferred grant 200, all else remaining the same. In the second option will be asset account debit 100 to bank 100, and that is it. So essentially, you are either allowed to credit the deferred grant account and then amortize the balance in the deferred grant in the ratio of depreciation, or you can directly net off from the asset, and hence the net asset balance will be depreciated over the life. So the special cases over here can be that what if the asset is received free of cost, in which case, if the asset is received free of cost, the problem would be, especially if you were to show the asset at the net balance. So 300 rupees you have paid and the government gives you a grant for 300, in which case the asset appears at a zero balance. Now the standard over here says that in such cases you will show the asset at something called as a nominal value. Nominal value is the value for namesake. It may be 1 rupee, 10 rupee, whatever it is. Just for namesake you will show the value of the asset at nominal value in case it is received free of cost, especially in case of the net method, because in case of a gross method still the asset will appear at 300 with the deferred grant of 300, but in the net method the asset will become 0. So when a shareholder does a site visit, they will see the asset but there will be nothing reflected in the balance sheet, and hence we will show it at nominal value, and then in the notes give an explanation on why this is appearing, let us say, at the nominal value. So that is the first special case. Second, so this is regarding grant received free of cost. You will take it at the lowest value, also called as the nominal value. Second, what happens, let us say, in case of the deferred grant method, if there is some non-depreciable asset like land, for example, if you were to get a grant for a freehold land that does not get depreciated, in which case the balance in the deferred grant will continue to remain. Well, under AS, you used to take it to capital reserve. Ind AS prohibits you from taking anything into the capital reserve. They will say that, okay, if you don't have the ratio of depreciation, you will amortize it in some other appropriate ratio, maybe the ratio of expenses that are incurred to fulfill the conditions of the grant, or maybe the life of the project for which the land is going to be used. Basically, you will have to find another appropriate ratio to defer the grant, but you will have to defer in an appropriate ratio, and you cannot just say that, well, it is land does not depreciate and hence we will keep it in deferred grant or capital reserve till perpetuity. That does not work. You will have to find an appropriate ratio and defer the grant in that appropriate ratio. Deferral is mandatory and we cannot credit the capital reserve in this case. Okay, next is what will happen if nothing is given in the exam, whether you want to follow the net or the gross. Well, either of the methods can be followed with a note written for the same, though usually the net method is usually a little more faster. Having said that, you can even follow the gross method. Either of the method kind of works. Now another special case would be in case there is a grant for an under construction asset. Well, if the grant is for an under construction asset, usually as good accounting practices, we can keep it into the deferred grant account till the time the asset is completed, and once the asset is completed is when the depreciation starts. You can either net it from the asset or you can continue as deferred grant and amortize in the ratio of depreciation. And lastly, there may be sometimes a confusion that, let us say, there are no conditions attached to the grant which is linked to asset. So when we study grant linked to income, if it is unconditional, we usually take it to the P&L, but that is only for grant linked to income. If it is a grant linked to asset, you will follow the principles as we studied earlier. That is, you will either take it to deferred grant or you will net it from the asset. You will not take it to P&L immediately, even if it is unconditional in nature and no specific conditions have been attached. Okay, next is grant linked to income. Every grant which is other than a grant linked to asset, it may be a grant in order for you to subsidize the selling price of your, let's say, inventory like LPG cylinders, or it may be a grant to meet expenses, like you may be a hospital and you are sending doctors to rural areas to meet those expenses, or it may be any other grant like a compensation for a flood, or it may be, let us say, a grant to set up a unit in a backward region. In all of these cases, the standard is very clear. It says that in all of these cases, you will treat it as a grant linked to income because it is not linked to acquisition of a specific asset. Now, how do you account for the grant linked to income? Well, it depends on whether this grant is unconditional or it is linked to some past losses suffered by the entity. If yes, then the standard says you can take it to the P&L. So if it is linked to certain past losses, these losses have already gone to the entity's P&L, and hence if the grant is received, you can credit the P&L directly. Or if it is not linked to past losses, it is given, let us say, at the time of COVID, the government said that to pharmaceutical companies we are giving a grant of, let us say, 50 lakhs for example, so that they can do research for the COVID-19 vaccine. Now you might do the research, you might not do the research, you might get a vaccine, you might not get a vaccine. Government says, independent of that, I'm giving you 50 lakhs. I don't know which company can kind of find a vaccine, but I need to find it on priority, so I'm giving support to these companies, and hence the government gives a grant. There are no conditions attached. In such a case, it can be taken to the P&L immediately, called as an unconditional grant. However, there may be a grant which is linked to certain conditions, like you might have to employ people, and keep them for a specified number of years, or it might be a grant for training and those training expenses are going to be incurred over a specified number of years. In such a case, the standard says that when the grant is received, you will credit it to the deferred grant account and then defer it in the ratio of expenses that are to be incurred. If you know the ratio of expenses which are expected, you will take it in the ratio of expenses, and if you don't know the ratio of expenses, then you can defer it in the ratio of time. So if it is 4 years, you will straight line it over 4 years, provided you don't have any separate ratio for the expenses. So grants linked to income, if it is linked to expenses, future expenses or future benefits, then you will create the deferred grant account and then spread the deferred grant account in the ratio of expenses or benefits or in the ratio of time. If it is unconditional grant or grant for past losses, then bank account debit to P&L will be immediate. A specific chart given for amortization of deferred grant balance, if any. So if there's a deferred grant balance, you will ask yourself that is it a grant linked to asset or a grant linked to income? If it is a grant linked to asset and there's a depreciable asset, you will defer it in the ratio of depreciation. However, if it is a non-depreciable asset like a land, then in any other appropriate ratio like expenses or project life. If it is grant linked to income and there are future expenses attached, then in the ratio of future expenses if available, else in the time ratio. And if there are no future expenses or conditions, it is linked to past losses or unconditional in nature, then you take it to the P&L immediately. There will be no need to create a separate deferred grant. Now this pertains to the accounting for grant linked to assets or grant linked to income initially as well as subsequently. A few special cases that can be discussed over here are first a forgivable loan, like before elections a lot of times government give farm loan waiver. Now this farm loan waiver has no connection or no condition attached in general, and as a result over here this will be like a quantifiable amount because there is a loan from a farmer by a farmer and that loan is waived off. So loan account debit in the books of the farmer, credit what? Well, if there are no conditions attached, it is not linked to acquisition of a specific asset, then the farmer will credit the P&L directly because it is a grant linked to income and not linked to the acquisition of a specific asset. Second, and a more important condition over here is what if it's a lump sum grant which is linked to promoter's contribution. Like if let's say Arunachal Pradesh is a state which wants people to set up businesses over there, and in order to incentivize, they say that we don't care whether you whether you own assets over here or you operate on rented premises. If you set up a business over here, we will give you a grant of, let us say, 5 lakh rupees. Now when entity sets up that business, gets a grant of 5 lakhs. Now this 5 lakhs is in the nature of promoter's contribution because it can be used for any purpose. To pay salaries to employees, for advertising, for the purpose of buying assets, it can be used for any purpose, and because it is not specifically linked to acquisition of a specific asset, this is also treated as a grant linked to income. Now, how will you account for it? Well, if there are no conditions attached, you will take it to the P&L immediately. If there are conditions attached, like you might have to generate employment and keep those employees, let us say, for a period of 3 years, in which case it is a grant linked to income, and there are conditions attached, in which case you will spread it over 3 years. The accounting will be exactly same as what you have for grants linked to income. Third is an EPCG scheme, Export Promotion Capital Goods Scheme. There is a specific ITFG case and an institute case as well on EPCG. So generally the objective of an EPCG scheme is you can import the capital goods and the duty that you will have to pay on the capital goods will be either given as a drawback or an exemption provided you meet specified export targets. Now the core objective in general of an EPCG scheme is to encourage exports. So the duty that is exempted on these capital goods, let us say on these capital goods, is primarily for encouraging exports, and hence the ITFG clarification says that this government grant, because it is quantifiable and support from the government in the form of a duty drawback, this government grant will be treated as grant linked to income and will be deferred over the years in the ratio in which the export obligations are met. So this is regarding EPCG, not very important. Now point 4 I would say is arguably the most important part of the standard, where you have loans at concessional rates. Now this is where Ind AS 20 has an interplay with Ind AS 109, where you have a loan taken from the government which is a financial liability, and as per Ind AS 109, financial liabilities have to be initially recorded at fair value if they are off the market. Now if the government has given you a loan at a concessional rate, like the market rate of interest is 10%, the government has given you a loan at 0% interest, in which case these are loans which are taken off the market, and as a result you will record the loan at fair value. Fair value is the present value of the future cash flows discounted at the market rate of interest, which is the fair market rate of interest. So if let us say it's a 5-year loan of 100 crores and the government says you pay me 0% and at the end of 5 years pay me the 100 back. In which case, as per Ind AS 109, the loan would initially be recorded at fair value, that is 100, discounted at the end of the 5th year by 10% rate, that is approximately 0.6 to 1, and then 62.1 crores will be the fair value. So ideally, if someone came to me, if I went to people and said that I'll repay 100 crores after 5 years, please give me an X amount today. In fair terms, they would have given me 62.1 crores. But the government has given me 100 crores and hence the excess, 37.9, is in the form of a grant, a hidden grant. So over here, the balancing figure will be the hidden grant. So your entry will be bank account debit 100 crores to, let us say, loan 62.1 crores to the balancing figure will be the grant, and the accounting for the grant will be as per Ind AS 20. So if it is a grant linked to asset, then the 37.9 can be reduced from the asset balance or taken to deferred grant and then deferred in the ratio of depreciation. Or if it is linked to income, then if it is linked to certain past losses, can be taken to the P&L immediately, and if it is linked to some future training that is to be done, then spread it over the years when the training is to be taken. So basically the first step over here is to find the fair value of the loan. Second step over here is to find the grant amount, which is the loan minus the fair value. And third, the grant should be accounted depending on the nature of the loan or the purpose for which it is given. The loan tenure over here is usually irrelevant. The amortization will be depending on the life of the asset, if it is an asset linked grant, or the expenses if it is a grant which is linked to income. The accounting for the loan will be as per Ind AS 109, usually amortized cost method. Okay, what if there is a refund of government grant? Now usually, initially you recognize the grant assuming that it is receivable, but at a later date you actually see that the conditions could not be fulfilled. Initially you thought that the conditions will be fulfilled, at a later date they were not actually fulfilled, and if they are not actually fulfilled, you will have to refund the grant. So how will you account for the refund? Well, refund will be accounted in the manner in which you initially recognize the grant. Like for example, if it was a grant linked to asset and you had credited the deferred grant account, then at the time of refund you will adjust it first from the existing balance in the deferred grant, excess if any going to the P&L. Again, if it was adjusted from the PP, you will first adjust it from the PP, make adjustments for depreciation and accordingly record the grant. If it is a grant linked to income and it had gone to the P&L, then at the time of refund you will debit the P&L. If it had gone to the deferred grant account, then you will again, the losses, you will adjust it first from the balance in the deferred grant, and excess if any will be taken to the profit and loss account. So this is regarding the refund. Sometimes what might happen is at the time of refund you might be levied an additional penalty. That penalty over and above will generally go to the profit and loss account only. So this is regarding an additional penalty. And lastly, when we look at the presentation of this deferred grant balance in the balance sheet, how will you present it? Well, at the time of deferred grant, it will appear as a part of liabilities, like an unearned revenue or a deferred revenue. So it will appear as a part of liabilities, can be split between current and non-current depending on the time when it is utilized. So for example, if the amortization is going to happen in the next year, that part will go in the current section, the remaining part will go in the non-current section, but it will appear as a part of liabilities and not as a part of reserves. When we look at the amortization of the grant, usually if it is a grant linked to assets and there is amortization of the deferred grant, it will be shown along with other income. It cannot be netted off from depreciation. However, if it is a grant linked to income, you have been permitted to either show it as other income or net it off from the expenses and show the expenses net. So this kind of takes care of the broad theory when it comes to Ind AS 20 pertaining to government grants. We will go to the Super 99 questions. For this, there are two questions, quite interesting ones. One is pertaining to the financial instruments impact and grant linked to assets. So question number 1, it's an interesting RTP question. Another question which is similar to a question which had come in the past and for which new clarifications have been given by the institute in the new study material and well deserving. Grant linked to income, we will discuss that. So let us get started. Question 1 and question 2 in your Super 99 set. So let us go to this question. Question number 1. Now A is engaged in the manufacturing of certain specialized chemicals, and during the process certain wastewater is produced and is released by A in the nearby river. To reduce the pollution, the state government has introduced a scheme with the following features. If the manufacturer installs a certain pre-approved wastewater treatment plant, so this is for installation of a specific plant, the government will provide an interest-free loan equal to 50% of the cost of the plant. Such a loan is repayable to the government in 5 years from the date of disbursal. So this is a loan, but this is an interest-free loan, and hence probably there is a hidden grant involved. The manufacturer availing the benefit must treat the wastewater using the specified plant, whether it before it releases. If the condition is violated, the entire loan shall become immediately repayable along with a penalty of 10 lakhs. So there is a possibility of a refund also over here. The cost of the treatment plant to be installed is 50 lakhs. Remember, against that 50%, that is 25 lakhs, will be the loan given by the government. He decided to utilize the scheme because if it were to obtain a similar loan, it would be available at a market rate of 12%. So this is the rate for fair loans. Accordingly, A applied and obtained the loan of 25 lakhs on 1st April 21. A Limited purchased and installed the plant on the same day it became ready for use. So this is a loan taken, plant purchased on 1st April 21. So the loan would be bank account debit to loan. But as per old standards, this loan would be recorded, let us say 25 lakhs. Under Ind AS, you will have to recognize it at fair value. So how will you find the fair value of such a loan? You will say that, well, what is the present value of future cash flows? Well, over here for this loan, 0 rupees for a period of 5 years, plus you will repay 25 lakhs at the end of the 5th year at a 12% discount rate. 1 divided by 1.12, 1, 2, 3, 4, 5. And this is 0.5674. So this is 25 lakhs into 0.5674, and it comes to approximately 14 lakh 18,500. So this is the value of the loan, but we have actually received 25 lakhs, and hence the difference between the two would be the grant amount. So 25 minus 14, 18. So 25 minus 14, 18,500, that is around 10 lakh 81,500 will be the grant amount. So at initial recognition, obviously you will record the PP at 50 lakhs. So PP account debit to bank, this is 50 lakhs, and then the loan will be recorded. Bank account debit 25 lakhs to loan 14 lakh 18,500, and then the remaining, depending on how the grant is classified. So 10 lakh 81,500 will be depending on how the grant is classified. This is a grant to acquire a wastewater treatment plant, and hence it is a grant linked to asset. Now if it is a grant linked to asset, you can either reduce it from the cost of the asset, that is 50 lakhs minus this 10 lakh 81,000, or you can credit it to the deferred grant account and then amortize it in the ratio of depreciation. Now what is the company actually doing? A has an accounting policy of recognizing the government grant in relation to depreciable assets in proportion of the depreciation expense. Now this will happen if you credit the deferred grant account, and hence you are probably following the method of deferred grant account. It has determined that the plant will be depreciated over 5 years using a straight line method. That means 20% depreciation each year. In the month of March 2023, that is 2 years later. So you had taken this loan and installed the machinery on 1st April 21. Today we are in March 23. That is 2 full years later. Government officials conducted a surprise visit and found that A was not using the wastewater treatment plant as prescribed, and accordingly on 31st March 23, the government ordered A to repay the entire loan along with the penalty of 10 lakhs. A repaid the loan with interest and penalty as per the order as on 31st March 23. See, the interest as agreed is 0%. So there is no separate interest to be paid. If there was certain interest, they would have mentioned, but there is a 0% interest loan. So there is no interest, but there is a penalty of 10 lakhs is what the institute has interpreted it. Measure the amount of government grant as on 1st April 21. So this will be probably 10 lakh 81,500. Determine the nature of the government grant. Well, this will be a grant linked to assets, and its accounting treatment principally for the year ended 31st March 2022, that is in the first year. Well, your entry will be bank account debit, at least for the grant, 25 lakhs, to loan 14 lakh 18,500, to deferred grant 10 lakh 81,500. Initially, this will be the 1st April 21 entry. If you go to see the 1st April 21 entry, bank account debit to loan, I think 14,17,500, or deferred grant income 10,82,100. I think they have taken slightly different decimals, and hence the answers are slightly different, though it can be maybe so they have taken 0.567. I think we took a decimal more, but nevertheless rounding off differences. So over here, this is for the year ended 31st March 22. Now for the year ended 31st March 22, the PP will be depreciated and the deferred grant will be amortized. So if I were to take 14 lakhs for loan and 10,82,500 divided by, let us say, 5, that is 2,16,500 will be the amortization. Deferred grant account debit to the profit and loss account, there will be an amortization. So depreciation will be taken, and then deferred grant to the profit and loss of 2,16,500 will be taken at 31st March 22. Okay, and lastly, they are asking also determine the impact on the profit and loss account of revocation of grant as on 31st March 23. So what will happen on 31st March 23? First of all, there will be a grant repayable. So the entire loan, that is 25 lakhs, would be repayable along with a penalty of 10 lakhs. So 25 plus 10, total of 35 lakhs has to be repaid. But once it is repaid, the loan liability will also not be there. So you'll have to find that what is the balance of the loan. So you'll have to find the loan balance on 31st March 23. To start off, let us say your loan balance in the first year was 14 lakh, I think 17,500, and to that you had recognized an EIR at the rate of, let us say, 12%. There was no coupon, and hence the closing would be found. So this would be 14, 17,500. To this you will have added, let's say, 12%, and hence this is 15 lakh 87,600. Again for the second year, 15,87,600, and to this you would have added another 12%, and probably this would be at 17 lakh 78,812. This must be the balance of the loan after 2 years. Similarly, you want to find the deferred grant balance. So if I look at the deferred grant balance in the year 1, I started with the opening balance of around 10 lakh 82,500. From this I subtracted 2,16,500 probably in the first year, and then 2,16,500 in the first year, and another 2,16,500 in the second year. So you will have probably 10,82,500 minus 216,500 minus 216,500, and this will be 6,49,500. So at the time of refund, you will first adjust the balance in the deferred grant. So you debit 6,49,500, but at the same time remembering that when you repay the loan, the grant also, the loan also is kind of settled. So over here your entry will be loan account debit. Let us say the loan will appear at 17,78,812. Then you will have deferred grant account debit. Let us say that comes to 649,500, and to bank if you have paid, or if to government grant payable, well, you can show 25 lakhs and pass a separate entry for 10 lakhs, or you can show 35 lakhs and show the direct balancing figure. I believe the institute has shown 25 lakhs and hence passed a separate entry. So this is, let's say, 17,78,812, and the balancing figure over here is around 71,688, which is to be taken to the profit and loss account. Apart from that, another entry for the penalty. So this is to grant payable, another 10 lakhs, and then PNL of 10 lakhs. So if I go to see at the time of refund, you will have to the profit and loss around 72,388 approximately, and another 10 lakhs going to the profit and loss. So this would be your entries at the time of refund. A fairly good question which will help you understand the deferred grant method for an asset link grant. Try to quantify grant in case of a loan at consensual rate, and also look at the refund of such grants. So this is an important question from a revision perspective for sure. So this is the first question. Another question would be question number 2. Now earlier this question had only one type of solution. Now the institute in the May 24 version thankfully has given you 2 alternatives. The first alternative in my opinion is more logical. The second alternative, well, you should do it the way the institute has done it to ensure a kind of consistency, though the first alternative in my opinion is more logical. Now entity A is awarded a government grant of 60,000 receivable over 3 years, that is 40,000 in year 1, 10,000 in each of years 2 and 3. So this is your total 60,000 of grant, contingent on creating 10 new jobs and maintaining them for a period of 3 years. So the conditions over here are to create the jobs as well as to maintain them. The employees are recruited at a total cost of 30,000. So that is the cost to recruit, and the wage bill for the first year is 1 lakh, rising by 10,000 in each of the subsequent years. So 1,10,000 in the second year and 1,20,000 in the third year. Calculate the grant income and the deferred income to be accounted in the books in the years 1 to 3 under the following situations. First, there's a reasonable assurance that the entity will comply with the conditions attached to them and the grant will be received. So if there's a reasonable assurance, then in general you will recognize the grant in its entirety irrespective of when the conditions will be fulfilled and when the money will be received. So you will recognize the entire 60,000. Now you might have received only 40, or you might have received nothing to start with. You will receive 40,000 in the first year. You will recognize the entire 60,000, and hence you will defer it. In what ratio? Well, it depends on whether the grant is in the nature of income or in the nature of assets. Well, it is not to acquire any specific asset, and hence this is a grant which is in the nature of income, and hence you will ask whether it is an unconditional grant or linked to past losses. Well, no, it is linked to you having to create jobs and maintain them for a period of 3 years, and hence this is treated to be a grant which is linked to income, and this is linked to future expenses, and hence it will be recorded over the 3 years as in the ratio of these expenses. So if I look at years 1, 2 and 3, your expenses in the first year will be 30,000 for creating the jobs and another 1 lakh as salary bill. So this is 1 lakh 30. In the second year, there is no further expense to create the jobs, but there is an expense to maintain it. That is a wage bill of 1 lakh 10. And in the third year, again 1 lakh 20. So your total expenses are around 3 lakh 60, for which the grant is around 60,000. Initially, your entry may be, let's say, grant receivable account debit 60,000 to deferred income 60,000. This should be your entry. Or if money has been received, then bank account debit 40,000, grant receivable account debit 20,000 to deferred income 60,000. So your deferred income balance will be 60,000, and this deferred income will be spread over the 3 years in the ratio of expenses. So over here, if I look at deferred income amortized, will be, let us say, 60,000 into 130 upon 360. Second year 60,000 into 110 upon 360, and in the third year 60,000 into 120 upon 360. So if I look at the amortization amounts, this is 60,000 into 130 upon 360 comes to, let us say, just a second, 60,000 into 130 upon 360. Let's say this is 21,667 of amortization, and hence the deferred grant balance, which was earlier 60,000, will be 60,000 minus 21,667, and hence this will be 38,333 at the end of the first year. Now when you go to the second year, this is again 60,000 into 110 upon 360. So this is around 18,333. Come to 20,000, and in the last year this will be entirely 20,000, and hence the deferred grant balance will become 0. And then in each year, as you receive the grant, you will have bank account debit, let's say 40,000 to grant receivable 40,000. In the next year, bank account debit 20,000 to grant receivable 20,000, and so on. So ultimately the entire, over the course, the grant will be received, and you will recognize the entire grant balance. Next, there can be a grant amortization. So when you look at the grant amortization, the entry will be deferred grant account debit to the profit and loss account, and the amounts would be 21,667, 18,333 and 20,000 in each of the years. So your balance in the deferred grant account will fall from 60,000 minus 21,667 to 38,333 and so on. If you go to see over here, the amortization is the same, and accordingly you find the appropriate deferred grant balances. This is under option 1, where there is a reasonable assurance that the grant will be received. Now the problem ideally arises, let us say, in option number 2. So when you actually go to option number 2, there is the fact that there is no reasonable assurance that the grant will be received. Now this is where the institute solution is a little inconsistent in my opinion, but that is how they have solved in the May 24 study material as well as a GFRS earlier paper. So might as well, if this comes, you go by the same logic. So ideally, if there is no reasonable assurance that the grant will be received, so you will do nothing till that grant is actually received, and once the grant is actually received, that is when you will do the accounting. So let us say in the first year 40,000 is received. So ideally your deferred grant balance will be only 40,000 in the first year, and your amortization ideally I'll again repeat, should be based on 40,000 only. Now, what institute has done is correctly they have said that okay, in the first year 40,000 is received, so 40,000 will be, let us say, recorded in the deferred grant account, bank account debit to deferred grant account 40,000. But when they go to the amortization, they do the amortization based on 60,000. Now, in my opinion, this is inconsistent, because if you are recording a deferred grant based on 40, your amortization at least in the first year should be based on 40. In the next year, yes, another 10,000 is received, so 40 plus 10, that is equal to 50. So till date, you can still do the amortization based on 50,000 in the second year. However, the institute has taken the amortization amount to be the same, that is 21,667. 18,333 and 20,000 exactly for each of the 3 years, which is based on 60,000. Now, if you're not recording the entire deferred grant, how can you amortize based on the deferred grant is, let us say, a sticky area. But nevertheless, if it comes in the exam, for the purpose of maintaining consistency, we will do the same thing. That is, you will do the deferred grant amortization based on the entire 60,000. However, the deferred grant balance will be calculated based on the amount that is received. Like for example, the deferred grant amortization will still be the same, that is 21,667, 18,333 and 20,000. Well, as you see, it's 21, 18 and 20,000. This is for part B, when there is no reasonable assurance. This is based on 60,000. However, when you sit to calculate the deferred grant balance, in the first year you have received only 40,000. So out of the 40,000, let's say 21,667 is amortized, and hence 18,333 will be your deferred grant balance. Now in the second year, along with the 40, you have also received another 10,000. So that is 50,000 that is received till date, out of which 21,667 has been amortized till date, and another 18,333 will be amortized till date. And as a result, what you are left with is going to be 10,000. Similarly, in the last year, total 60,000 is received, minus 21, 18 and 20,000 coming to 0. Now, this is a little inconsistent in my opinion, but if it comes in the exam, I would recommend that you go with the same flow to ensure that you are consistent with the ICI solution. Now, this kind of takes care of the Super 99 questions, but I would also want to discuss another question from your test your knowledge on your study material, page 7.50. Not that it is very difficult, but it is similar to a past exam question, and it also covers a few more areas, so might as well spend a few minutes and wrap that up as well. So this is question number 1. There's a company ABC who has received the following grants from the government of Delhi for its newly started pharma business. First, 20 lakhs received for immediate startup of business without any further condition. So this is a grant which is not linked to an acquisition of asset, so it is a grant linked to income. And because there are no further conditions attached, we will take it to the PNL immediately. Second, 50 lakhs received for research and development of drugs required for treatment of cardiovascular diseases with the following conditions. The drug should be available to the public at 20% cheaper from the current market prices, and the drug should be in accordance with the quality prescribed by WHO. Now, there are certain conditions attached. This is not a grant linked to acquisition of a specific asset. It is just providing medicines at a cheaper price, and as a result, it is a grant linked to income. However, it is not unconditional. You will be getting this only if you fulfill those conditions. So if you assume that those conditions will be fulfilled, the grant can be recognized. And this is also a grant which is suited to be a grant linked to income and to be recorded in deferred grant and amortized to the PNL over the years when these expenses are likely to happen. Okay, over here some argument can also happen that this can be treated to be similar to an intangible under development, which argument is possible, but institute treats it to be like an expense for research and hence takes it to the profit and loss rather than treating it as an intangible. 2 acres of land whose fair value is 10 lakhs was received for setup of a plant. So this seems to be received free of cost, in which case this is a grant linked to asset, and this can either be taken against the deferred grant account or it can be reduced from the value of the asset, in which case the asset will become 0, in which case you will have to show it at the nominal value. So if I decide to show the net method, I'll have to show the land at nominal value, and if I decide to show the deferred grant method, then I can show this entire 10 lakhs within the deferred grant balance. 2 lakhs received for purchase of machinery of 10 lakhs. Again, this is for purchase of machinery, so this is a grant linked to asset. Useful life of the machinery is 5 years. Depreciation is to be charged on a straight line basis, in which case the depreciation on the machinery will be 10 divided by 5, that is 2 lakhs per annum. If I decide to take this within the deferred grant account, then 2 divided by 5, that is equal to 40,000 will be deferred in each of the years. If I decide to net it from the asset, then 10 minus 2, that is equal to 8 will be the asset balance, and the depreciation in each year will be, let's say, 1,60,000. Recommend how should ABC recognize the grants in its books of accounts. So these are the various various types of grants which can be accounted in your respective books. So this kind of takes care of Ind AS 20. I hope this video has been helpful to you. If yes, please show some love and press the like button. Share it with your friends if you think it is helpful, and comment if you have any suggestions, or if you like more such videos, let me know which videos will help you most. Okay, that should be it. I'll see you soon with another video. Till then, goodbye, good luck, and study hard. Take care.